Google 20x, Amazon 100x, Carvana losing money, HubSpot losing money. And every tech stock I look at is either losing money or priced to the point where my grandkids wouldn't make money on this stock in a bad market. How can I invest in tech without feeling like I'm just gambling? In this video, I'll go through the concepts in Adam Seesel's seminal book, Where the Money Is, and how you can apply them to pick the next Amazon or Google. You can see that the adjusted PE for Google at that time was 9x. Adam started at Sanford Bernstein. Their motto was buy what's cheap. Eventually, life will return to normal. Problem was, in the 2010s, he noticed his model, which sought to buy stocks when they were historically cheap, was just no longer profitable. After much soul searching, Seesel realized things had changed. Life was not going to return to normal. Surprisingly, Buffett had even beat him to this realization with his investment in Apple. Up until then, tech was considered unsafe in the old school of value investing. Thought was that companies like Apple could be dethroned by a new competitor, just a new upstart. But it was clear if Buffett could get comfortable with Apple, the software and tech revolution and the companies that came with it were here to stay for the long run. And boy, was it obvious in the stock market. This wasn't the first time value investing had been turned upside down. Though to understand the story, we need to go back to the founding of value investing in the 1930s with Ben Graham. Value at that time was unheard of. Stock buying was a gambler's game and professionals stuck with bonds. Imagine a stock market with just meme traders and no hedge funds on the other side. Ben Graham brought to the market what seem now to be common sense ideas, but they were brand new for the time. His first idea was to buy assets below liquidation value, or what they would be worth if the company was to shut down completely. By doing this, you're much more likely to make money because you've already covered your downside risk, so there's only upside from there. His second game-changing idea at the time was how he viewed the market overall. He came up with the character Mr. Market. Mr. Market is famously temperamental. One day he'll be extremely happy and offer you $100 for a stock, but just as easily he could come in the next day dejected and depressed and offer you a price of just $10 for the same stock. He doesn't have any rhyme or reason to how he picks prices in the short run, but in the long run, the market moves towards the true value of a stock. Graham made it his job to take advantage when Mr. Market was offering things below what he considered to be intrinsic value. During the Great Depression and the years after, Graham made a killing with his simple strategy. Soon, everyone was doing it, and the professionals had joined him in his analysis. The search for Ben Graham net nets was no more. Ben Graham famously remarked later that his best investment wasn't a net either. Rather, it was one of Buffett's seminal picks, Geico, the poster child for what would become Value 2.0. Warren Buffett, with the help of Charlie Munger, would later perfect Value 2.0. Instead of buying businesses below liquidation value, they bought great businesses at reasonable prices. Most of Buffett's recent buys have been established companies with strong brand names or other types of similar competitive advantages that allow for a company to continue to slowly grow from its current position at a normal middling rate. Unfortunately, Buffett's picks completely missed the massive growth of the tech sector until he bought Apple. The moment Buffett bought Apple, Value 2.0 became Value 3.0. So what are the rules to Value 3.0 that allow you to buy tech stocks at a reasonable valuation so you don't feel like you're gambling? First and foremost, you need a high quality business. Adam Seesel asked 3 questions for every company he's analyzing. 1, does the company have a low market share? 2, is it in a large and growing market? And 3, does it have a sustainable competitive advantage? These questions are extremely important because you don't want a mature company with no future growth ahead of it. They define what is a good tech business. You want to be in a market that's growing and you want a lot of room to grow into that market. And lastly, you want some type of competitive advantage that will allow you to protect your profits. There's 3 major types of advantages you'll often see. First is the low cost advantage, the company that is the cheapest out of the bunch. Think of Costco or Walmart. As a result of their scale, they're able to provide lower and lower prices to their customers while continuing to push out their competitors because they cannot compete at those low prices. Next is the brand advantage, or the emotional connection a company has to its customers. Think of Mickey Mouse and Disney or Coca-Cola. These companies have built an emotional connection with their customers that's unlikely to go away anytime soon. Last and most importantly, you'll see companies that have built a major competitive advantage thanks to network effects. The network effect states that the company that has the most users will be able to provide the most value for all those users. And so the flywheel will turn faster and faster as you get more users, therefore being able to provide more value to your customers. Airbnb is a perfect example of the network effect. First, you have people willing to put up their homes on Airbnb. Then you'll get users. The greater number of users will allow you to have more people willing to put their homes up on Airbnb because that's where the buyers are. And so the flywheel continues. These 3 questions will let you determine whether a company is a high quality business. Secondarily, you want high quality management. There are 2 questions you need to answer to figure this out. 1, does the management think and act like owners? When management acts like owners, they try to protect their stock. Usually less than 1% of the stock of a company is being diluted every year. A company that's run by owners. Second, a company that's truly run by owners is a company that's often run frugally, not as an ATM for the wants and needs of the executives. Unfortunately, it's not out of the ordinary for you to see executives buying private jets and gathering security details of 20 Navy SEALs deep. Those are the executive teams you want to stay away from. Next, you need to know whether the executives understand what actually drives business value. Question Seesel likes to ask his CEOs is what's more important, ROE, revenue growth, or earnings? If your CEO says ROE, you've probably got a good CEO. Sales and even profit are all a function of the equity being used to derive that profit. ROE, or return on equity, is what matters most to owners. Seesel was surprised to find that the majority of his executives would actually get this answer wrong. You and I might not be able to go ask CEOs these questions directly. You can listen to their earnings calls and decipher this because many analysts will ask questions very similar to this. Now that you've got a high quality business and high quality management, that's when you want to actually go look at the price of the company and figure out whether it's actually worth buying. Problem is, PE, or price to earnings ratio, that you see in most of these tech companies is so high that it seems like it just doesn't make sense to buy it. The truth is, those PEs aren't coming down anytime soon. It's actually a good thing. So the price to earnings ratio is a great way to figure out whether a company is a good buy or not. Fortunately, it doesn't work really well with tech companies. Unlike steel mills or car companies, whenever a tech company chooses to build a new product, almost everything it spends to build that product in R&D is expensed that year. Whereas at a steel mill, it's expensed over the next 20 years, or the useful life of that steel mill. As a result, the tech company earnings include all of the costs that they incur to build their own products. Industrial company earnings will spread out the cost of a new product over many, many years, whereas software companies don't have the ability to do that as a result of GAAP accounting. Seesel adjusts for that by using the earnings power framework. First, he uses earnings 3 years out to take into account the strong growth in the companies that we're looking at. Then, instead of using the margins that we see today, he'll apply steady state margins to these companies. The margins you'd expect from a company that wasn't spending all of their cash to continue to grow at high rates, as most tech companies do. Look at Amazon and Google and Intuit. All these companies spend a lot of money on R&D trying to build a better product and greater lead against their competitors. The thinking behind this is that as long as the company is investing to build long-term customers, as many of these companies are, they should continue to maximize their growth, as that is the best use of their capital. If they instead reduce their growth rate and became profitable today, they will open themselves up to competition from others that choose not to do that. On top of that, doing so is not a very tax-efficient way of building shareholder wealth. Just see my tax explanation in the Sproner framework video up here. Let's break this down with an example. With Alphabet stock in 2016, Adam Seesel used his system to value Alphabet, and it's a perfect example. So first, does the company have a low market share? Yes, in 2016, digital advertising was just 25 to 30% of total ad spend. Google had about 60% of this market. So Google had a 15% share of the worldwide ad market. At its peak, print advertising was 80% of total ad spend. So it's clearly in a large market with a lot of growth still ahead of it. And that's without even taking into account YouTube and all the other verticals that Google's added since. Next, is Alphabet in a large and growing market? Yes, global advertising spend is at about $500 million. And when Seesel looked at this, and he looked at the entire market of advertising, he saw that the entire market was close to $1 trillion. So there's a lot of growth ahead for Google. Does Google have a sustainable competitive advantage? Yes. Search is a network effects business. Google's built the fastest search engine out there, leading to the most users, leading to more advertisers, leading to more money, which Google then reinvested back into its product. This flywheel allowed them to far outcompete their competitors. Next, does management think and act like owners? Page and Brin have become so rich that they're not really thinking like owners. But Sundar Pichai, on the other hand, an up-and-coming executive at the time, was starting to think like an owner. Next, do the executives understand what drives business value? Page and Brin, it's hard to say. They understand what's important in a product to customers, but they also really like moonshots, which are often expensive and hard to predict whether they'd be worth it at a time in the future. But since the move towards executives like Ruth Porat and Sundar Pichai, this has changed. Lastly, was Google worth it back in 2015 when Seesel was buying this? He looked specifically for an earnings power yield of greater than 5%. By projecting out 3 years and using the 40% margins of a competitor, specifically Facebook in this case, that had shown much better management. You can see that the adjusted PE for Google at that time was 9x. When Seesel first bought the stock. Since he's invested, it's clear that he made the right bet. Alphabet has handily outperformed the larger market, and their margins have grown to 30% from 25% at the time. Using the BMP valuation framework from Seesel's book on Alphabet today yields an adjusted PE of just 8. That's less than half the PE of the S&P 500 today for a company that grew revenues by 40% in 2021. If you want to see some investors putting these learnings into action, check out my video on the investors that will make a killing in the 2022 market crash right here.